Welcome. My name is Aneeqa Aqeel, and I'm head of HFR Media. Thanks for joining us today for this panel interview with three area experts in healthcare, event-driven, and technology investing. Today, we review performance in these sectors and take a look at what to expect in the months ahead. Stay tuned. Joining us now is Alex Forschner, president of Exome Asset Management. Hi, Alex.
Hi, how are you?
Good, thanks. So healthcare, which is part of our sub-strategy space in the equity hedge index, has stood out in June as a high performer against a backdrop of sticky inflation and interest rate expectations and the growing geopolitical and election risks we face. What's your take on this, Alex?
Well, thank you very much for the time and questions. So, it's very interesting because healthcare, even though had a good June overall year to date, it's been challenging. Looking at the XBI as an example, I think the XBI was up about 4% to the end of June compared to the S&P, which is up about 15%. So, looking at June, June reflected much of the action that describes Q2 for healthcare performance. The sector witnessed several positive fundamental events. Overall performance remained subdued after a pretty promising start in Q1 with heightened M&A activity and anticipated rate cuts fueling optimism, which we're seeing that now. Biotech's momentum was dampened by broader macroeconomic trends. Also, few rate cuts and a strong showing from tech triggered a shift away from biotech, sparring really only the select large cap favorites and the GLP-1 staples.
Okay, and so what do you foresee for the rest of the year?
So from a fundamental perspective, biotech remains robust halfway through the year. The sector has seen a high success rate in clinical trials, with companies like Insmed and Intracellular achieving pretty significant phase 3 wins for multi-billion-dollar indications. Generally, Q2 earnings setups look favorable in pharma and medtech, and a bit more constrained in life science tools. There has been increasing momentum in discussions regarding elections and policy volatility to healthcare related to both Trump's improved odds and potential for a new Democratic nominee, as well as the Chevron case, which impacts the statute of authority for agencies such as the FDA. So our belief is that neither of these should create much of a change to the sector in the short term. And we're pretty optimistic for the second half of the year for biotech and healthcare as well.
Fantastic. Thank you for your insights.
My pleasure.
And we're joined now by George Schultze of Schultze Asset Management. Welcome back, George.
Thank you. Nice to be here.
So I've got the graph up on the screen. Although the HFRI 500 event-driven index has been a bit muted month to month, including most recently in June, year to date, it's up by over 2%. What's your analysis of the last quarter, George?
It was kind of an interesting quarter in the markets. I mean, we're seeing more and more interesting events right now. The interest rates are much higher now than they were 24 months ago. You also have an economy that's still chugging along with pretty decent growth. Inflation is hovering at about 3%, and unemployment remains very low.
Mm-hmm.
So there's a question now about whether the Fed is going to finally reduce interest rates. The policy rate, which in the mid band is 5.375% right now for the Fed funds rate. You've had a slight decline in money supply year over year. But concerningly, you still have an inverted yield curve.
Yeah.
And those are some of the sort of main macroeconomic things we're looking at here at Schultze Asset Management. Now, on a fiscal side, you also have a lot of uncertainty with the government. I mean, there's concern now with the U.S. election, whether the incumbent president might be incompetent entirely, maybe steps out of the race, or maybe even steps out of the operating the U.S. presidency. We'll see before it ends. So those are some big changes. But for the government itself, you have a very over-levered balance sheet with over 120 trillion in liabilities. It seems that no matter which party comes in, you're going to continue to see inflation. And if you lower interest rates now, like lots of people are hoping and expecting Powell to do after this week's testimony, there really is a question about the dollar and the strength of the dollar. So we're recommending at Schultze Asset Management that all client portfolios do some hedging to protect against inflation risk. But there's also likely to be a fair amount more of stock market volatility through the end of the year and through the election, and then probably after the election as well. At the same time, with interest rates having climbed so much, especially starting from the policy rate, but reflecting through to basically every borrowing, whether it's corporate or consumer or the government as well, the cost of servicing that debt has skyrocketed, and so you're seeing more bankruptcies. And that really plays well to the strategy we deploy here, which is event-driven with a focus on distressed securities investing. There are more companies to short, more companies that will go through bankruptcies and restructuring. And then on the other end, after they do so, more companies that will be able to benefit by either buying back their stock or maybe paying special dividends. So it's a really good environment right now, we think, for our strategy. Overall, for the event-driven space, it's interesting that slide you put up earlier. I'm surprised to see that space has slightly lower returns than some of the other ones year to date. But I do think it's a good time for the market, and I think that'll continue. In fact, our fund is up over 21% year to date, so we're excited about that return. But these are broad indices, so there are lots of different components within them.
Sure. Well, thank you so much for your insight. I appreciate it, and we'll see you again soon.
Of course. Thank you, Aneeqa.
And we're excited to have Kim Bolton, president of Black Swan Dexteritas, joining us now. Kim, it's great to have you with us.
Thank you very much, Aneeqa. The pleasure is mine.
So it'll come as no surprise that our technology sub-strategy indices continue to show good performance in June, as well as what we're showing here year to date. How would you assess performance in tech in this last quarter? And looking ahead, do you expect momentum in this sector to continue?
Well, thank you very much. This is what we do. Black Swan Dexteritas is very well known, almost a brand within the publicly traded technology arena. So, ever since the beginning of November 2023, for the last 9 months, except for that month of April, it's been moving from the lower left to the upper right, which is exactly what investors like to see. The reason for it is pretty simple. Primarily because of the AI revolution. But then, of course, you've had interest rates. If you go back to, a year ago where you had the 10-year treasury upwards of 5%, and now you actually have it down around 4.20, 4.25. So easing interest rates have allowed a lot of the technology arena to go back to leveraging and using the cheaper money to actually grow their business. But in particular, it's not the whole of the technology arena that is leading the parade for this AI revolution. It's the picks and shovels. It's the semiconductor companies. It's the hardware companies that are supplying the racks and the routers and so on, which, in the early stages of a technology revolution like we're experiencing with generative AI, this is normally the hardware side. You can definitely, the software sector has taken a back seat, but I think come 2025, you'll see the software side also get a boost coming out of that. However, it's a proven fact, going back to the beginning of stock markets, that the stock market goes up 80 to 85% of the time. So think of it, in a 12-month year, now we've actually spent the better part of 9 months, about 80%, almost 80% of that time with the stock market moving up, primarily led by the picks and shovels out of the AI revolution. So we think as we come into this sort of seasonal period, which is normally a bit soft in the stock market, of sort of August, September, October, we believe that you'll have a very natural correction, not too deep. It could be either side of 10%. But then going into the final quarter of the year, particularly November, December, things will get back on track. The way we're positioning right now is that we're almost fully invested. Some of our stocks in the technology arena have reached price targets, so that's why we have about 5% cash. But we also have a hedge, which is made up of short equity as an overlay on top of the stock portfolio. So our hedge actually accounts for about 34% of the notional value of the stock portfolio. You know, in a neutral position, we're probably at around 25% short equity index overlay, so we're slightly overweight. But, you know, as we go into this period of August, September, October, you would expect us to sort of dial it up. But in the meantime, you ride the wave and the momentum of this AI revolution.
Fantastic. Well, thank you for your insight. I appreciate your time. Thank you for joining us.
Thank you very much, Aneeqa.
If you're interested in learning more, please reach out by emailing hfrmedia@hfr.com or access our website at hfr.com and sign up for updates. Thank you.